Your insurance company is betting you never check this. That bet is costing you $2,000 a year. Most homeowners assume their policy is a fixed cost, but the truth is you are likely overpaying for coverage you don't need while missing discounts you've already earned. In this video, we'll pull back the curtain on the specific line items insurers use to inflate premiums, and I'll show you exactly how to audit your policy in under 10 minutes. According to the Insurance Information Institute, 1 in 5 homeowners never shops around for insurance, and those who do save an average of $1,200 annually. Meanwhile, a 2025 study by J.D. Power found that 68% of policyholders are unaware of at least one discount they qualify for. With home insurance rates rising 12% year over year, leaving money on the table is no longer just careless, it's expensive. Think of your homeowner's insurance as a leaky faucet. Most people notice the drip, the monthly premium, but ignore the slow, silent loss of water down the drain. That leak is the $2,000 in overcharges, duplicate coverages, and missed discounts. By tightening just a few valves, you can stop the waste without sacrificing protection. 1. The replacement cost trap. Your policy likely covers your home at replacement cost, but insurers often inflate this number using outdated construction data. Check your dwelling limit. If it's more than 20% above your local rebuild cost per square foot, you're paying for phantom coverage. A 2024 report from the National Association of Insurance Commissioners shows that 30% of homeowners have dwelling limits 30% higher than actual rebuild costs. Number 2. Duplicate coverage you already paid for. Many policies include line items like water backup or identity theft that are already covered by your umbrella or auto policy. I've seen clients paying $150 a year for sewer backup coverage that their state's basic homeowners form already includes. Cross-reference your declarations page with your other policies to eliminate redundancy. 3. The deductible inflation game. Insurers are quietly raising minimum deductibles from $500 to $2,500 or even $5,000. A 2025 study by the Consumer Federation of America found that 40% of policies now have a default deductible of $2,500, up from $500 just 5 years ago. If you haven't reviewed your deductible in 3 years, you're likely paying for a higher threshold than you agreed to. Before, loyalty penalty instead of loyalty discount. Insurance companies reward new customers, not loyal ones. After 5 years with the same carrier, your premium increases an average of 8% annually, according to a 2024 analysis by the Zebra. Shopping around every 2 years can save you $800 a year, yet 60% of homeowners never switch. Number 5. The hidden discounts you're not using. Bundling home and auto is obvious, but few know about discounts for new roofs, smart home devices, or even being claim-free for 5 years. A 2025 survey by Policy Genius found that the average homeowner misses $400 in discounts annually. Ask your agent for a full discount audit. Most won't offer unless you ask. Here's your one concrete step. Pull out your most recent declarations page and check the dwelling limit, deductible, and any duplicate coverages. Then, call your agent and ask for a full discount review. If you want to see exactly how I saved $2,400 on my own policy, click the video linked here. And don't forget to subscribe. Next week, we're dissecting the fine print of life insurance riders.